Hey there, financial explorers, and welcome back to the channel where we demystify the markets. Today, we're shining a spotlight on a stock that has triggered our hard-to-borrow screener with some truly eye-popping metrics. We're talking about CIIT International Inc., trading under the ticker CIIT. This isn't financial advice, but a deep dive into what makes a stock hard to borrow and what that could potentially mean. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Joe Chart CIIT. Let's get straight to the profile of CIIT. CIIT International Inc., through its subsidiary, Washing International Company Limited, operates in the industrial sector, specifically integrated freight and logistics. They provide crucial logistics services across Hong Kong, Vietnam, Japan, and South Korea, offering everything from ocean freight forwarding to container shipping. With the market cap currently sitting at a modest $4 million, CIIT is a micro-cap player. Looking at recent price action, it's been a tough period for CIIT shareholders. The stock is down 13.33% today, a significant 20.31% over the last 5 trading days, and a staggering 67.50% over the last month. Volume-wise, today saw 377,200 shares trade, which is notably low compared to a 30-day average volume of nearly 15.3 million shares. This means its relative volume today is practically 0x its average, indicating significantly reduced trading activity. What is cost to borrow and why it matters? So, what does it mean when we say a stock is hard to borrow? At its core, the cost to borrow, or CTB, is the annualized fee that short sellers must pay to borrow shares they intend to sell. When a stock becomes hard to borrow, it means there's high demand from short sellers and very few shares available to lend out. Think of it like a hot commodity. If everyone wants it and there's hardly any supply, the price skyrockets. This is precisely why you see CTB fees, like CIIT, soaring into the hundreds or even thousands of % annually. It's the market's way of pricing the scarcity of borrowable shares. Why the stock is hard to borrow right now. Highlight CTB fee, 626.1%. Now, let's look at CIIT's hard-to-borrow specifics. The current annualized cost to borrow fee for CIIT is an absolutely staggering 626.1%. To put that in perspective, this is an incredibly high premium to pay to hold a short position. While the cost to borrow has seen a notable decrease of 70 percentage points over the last 5 trading days, indicating some short-term pressure relief, it remains at this exceptionally elevated level. What truly makes CIIT stand out is the borrower supply. There are currently only 3,000 shares available to borrow. Compare that to an estimated float of 7.3 million shares. This scarcity of borrowable shares, combined with the high fee, is why CIIT appeared on our screener. Our internal composite squeeze score for CIIT sits at 49.0 out of 100, indicating a moderate but not extreme potential for a short squeeze. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have very strong conviction in their bearish thesis and are willing to pay significant fees to maintain their positions. Squeeze mechanics explained. Zoom in on the concept of covering. Let's break down the mechanics of a short squeeze, especially when a stock like CIIT is hard to borrow. Imagine short sellers are paying an exorbitant 626.1% annual fee to maintain their short positions on CIIT. If the price starts to tick up, they are not only losing money on their short trade but also incurring massive daily fees. This creates immense pressure. To limit their losses and stop paying those fees, short sellers must cover their positions, which means buying back the shares they initially sold short. This sudden influx of buying demand, forced by short sellers, drives the price even higher, which in turn forces more short sellers to cover, creating a rapid upward spiral as the short squeeze. With only 3,000 shares available to borrow against a 7.3 million share float, any significant buying pressure could quickly create a very tight squeeze scenario. Dilution risk check. An important factor to consider for any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can negate a short squeeze thesis in 2 main ways. First, by increasing the share count, it requires much more buying pressure to move the stock price, and second, these newly issued shares can potentially become available to borrow, easing the pressure on short sellers and reducing the cost to borrow. For CIIT, we've found good news on this front. There have been no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. Furthermore, we haven't found any recent reverse splits in our look-back window. This suggests that the current high cost to borrow is not being immediately offset by new share issuance. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Highlight volume drop. Given CIIT setup, what should you watch for? First, monitor the price action carefully. Despite the extreme cost to borrow, CIIT has been trending significantly downwards, losing over 67% in the last 30 days. This indicates a strong bearish sentiment as selling pressure currently dominates. Second, keep an eye on the volume. Today's volume of 377,200 shares is a minuscule fraction of its 30-day average of almost 15.3 million. This extremely low relative volume could indicate a quiet period before a potential move, or simply a lack of broad interest at current levels. Any sudden surge in buying volume, especially on green days, could signal a shift in sentiment. Finally, continue to track the borrow metrics. Any further decrease in available shares or an even greater spike in the cost to borrow for CIIT would be significant. In summary, CIIT International Inc. or CIIT presents a compelling case study for a hard-to-borrow stock with its staggering 626.1% cost to borrow and incredibly scarce 3,000 shares available to borrow. While the dilution risk currently appears low, the stock has experienced significant downward momentum and extremely low relative volume recently. Always remember that high cost to borrow is a factor in a potential short squeeze, not a guarantee. It takes a catalyst, combined with buying pressure, to truly ignite one. If you found this deep dive into CIIT and hard-to-borrow stocks valuable, please hit that like button, subscribe for more educational content, and let us know in the comments what other stocks you'd like us to analyze.